Imagine a hidden market, operating just beneath the surface of our everyday lives. A market where the assets being traded aren't stocks, bonds, or precious metals like gold, but human lives. Real people, with families and dreams. Massive corporations quietly take out, without fanfare or public announcement, life insurance policies on their employees, a practice that's far more common than you might think, often and shockingly, without the employee's full knowledge or informed consent. This practice is called bank-owned life insurance, a rather sterile and detached name, or BOLI for short. The bank owns the policy outright, holding all the rights and privileges, pays the premiums diligently, ensuring the policy remains active, and ultimately collects the tax-free payout, a significant sum of money, when an employee dies. The benefit goes directly to the bank, not the grieving family. It's presented as a sophisticated financial strategy, a way to offset costs, but in reality it turns a human life with all its inherent value into a mere line item on a balance sheet, an asset that cruelly matures only with death. Banks use these policies, they claim, to fund employee benefits and to cover rising operational expenses, but the undeniable truth is that the real profit comes, and it's substantial, when a worker unexpectedly passes away. The death benefit, a payout triggered by loss, is a completely tax-free windfall, a pure gain for the corporation's bottom line. This isn't some fringe tactic employed by a few rogue institutions. It's a widely accepted cornerstone of modern banking practices. The people processing your checks, handling your transactions, or answering your calls with a polite tone could unknowingly be part of this vast and unsettling portfolio. Their lives, without their explicit consent, are assets. Their deaths reduced to a mere liquidation event, a financial transaction for the cold calculations of the bank. Tragically, most employees have absolutely no idea their lives, their very existence, are being used in this way, without their knowledge. It's a cold, calculated system, devoid of emotion or empathy, hidden in plain sight, a secret market operating in the shadows of our financial institutions. This market is massive, over $400 billion. Major banks like JP Morgan Chase and Wells Fargo hold billions in these policies. Why so secretive? First, the optics profiting from employee deaths is a PR nightmare. Second, it's a lucrative, tax-advantaged strategy banks want to protect. The tax-free growth and payouts make BOLI a goldmine. Public scrutiny could threaten the loopholes that make it so profitable. The bigger the workforce, the more predictable the returns. Banks use actuarial tables to forecast how many employees will die each year. This transforms unpredictable human life into a steady stream of revenue. It's a profit engine fueled by mortality. Here's how it works. A step-by-step breakdown of this controversial practice. Banks select huge pools of employees, often thousands at a time, sometimes even former staff, those who have already retired or moved on, to insure. They take out life insurance policies on these individuals. Employees often aren't aware of this arrangement, as broad consent is buried deep within the fine print of hiring paperwork. It's often overlooked or not fully understood. The bank pays the premiums, diligently maintaining the policies, owns the policy, maintaining complete control, and is the sole beneficiary, meaning they are the only ones who profit from it. These policies are worth millions, sometimes even tens of millions, and grow in value over time, becoming a substantial asset for the institution. Banks can borrow against the cash value, leveraging these policies tax-free, further enhancing their profitability, making it a flexible asset, a valuable tool in their financial strategy. Even after employees leave or retire, severing ties with the company, the bank keeps the policy active, continuing to pay the premiums. These ex-employees are grimly called dead peasants in the industry, a stark and unsettling term. When a covered person dies, when one of these insured individuals passes away, the bank files a claim, initiating the payout process, and receives a tax-free payout. A significant sum of money. The money goes straight to the bank's bottom line, directly impacting their financial performance, funding benefits, enhancing employee packages, or just boosting profits, increasing their overall revenue. It's a quiet, efficient cycle, a continuous loop of investment and return. Invest, wait, collect. The system is impersonal, devoid of any emotional consideration, tracking portfolios, not people. Focusing solely on the numbers, death becomes just another financial transaction, a line item on a spreadsheet. This isn't just theory. These aren't abstract concepts we're discussing. It's about real lives, real families, and the very tangible impact this practice has on them. Take Daniel Ammerman, a seemingly ordinary individual. He was a Texas bank teller, diligently serving customers day in and day out. Years after leaving his job and after his passing, he died, leaving behind loved ones. But his former employer, unbeknownst to him or his family, collected a payout, a life insurance benefit. Tragically, his family got nothing from this policy. Winn-Dixie, a major grocery chain, insured 36,000 employees, a massive undertaking. They were profiting millions from their deaths, turning human lives into a revenue stream. Legal challenges, attempts to fight this practice, ultimately failed to stop it. Major banks, some of the largest institutions in the world, hold billions in these policies, a staggering amount of capital. Bank of America, for example, holds over $20 billion in these types of policies. Wells Fargo, another financial giant, nearly $18 billion. This is not a rare loophole, a minor oversight in the system. It's a widespread, deeply institutionalized strategy implemented at the highest levels. The term dead peasant insurance, a stark and unsettling phrase, actually came from within the insurance industry itself, a candid admission of the practice. Employees become statistics, mere data points, not people with families and dreams. Just numbers on a balance sheet, assets to be managed and profited from. The system is coldly designed to be impersonal and efficient, maximizing returns with ruthless precision. News of a death triggers a financial windfall, a transaction processed without emotion, not a moment of mourning, no pause for reflection on the life that was lost. The human cost, the suffering and loss, is deliberately hidden behind layers of complex financial jargon and legal obfuscation. It's a chilling reminder, a stark illustration, of how far profit motives can go, how easily human dignity can be sacrificed in the pursuit of financial gain. This isn't just a banking oddity, it affects us all. When corporations get billions in tax-free income, taxpayers make up the difference. That's less money for schools, roads, and healthcare. Many employees never knew they were insured. Consent was buried in paperwork. In a world of hidden data and fine print, Bali is a stark example of how our lives can be commodified. It raises urgent questions about transparency, consent, and dignity. Should a company profit from your death? The existence of this market says yes, but should we accept that? It's time to ask where we draw the line between profit and people.